How is Kimberly's strategy for reducing her retirement taxes by doing Roth conversions and qualified charitable distributions? Is Patrick's tax loss harvesting transaction a wash sale? At what marginal tax rate should Brian stop making Roth 401k contributions? Joe and Big Al are back to answer these questions today on Your Money, Your Wealth podcast number 486. Plus, how important is international stock in John and Seattle's diversified investment portfolio? What impact will a new home purchase have on John and DC's retirement spending? Should Blake take his severance package now or work a few more years? I'm producer Andy Last with the hosts of Your Money, Your Wealth, Joe Anderson CFP and Big Al Clopine CPA. Visit yourmoneyyourwealth.com and click Ask Joe and Big Al on air to ask your money questions via email or a priority voice message like this one on Roth conversions and I-bonds.
Hello, Joe and Big Al. My name is David. My wife's name's Terri, and we're from sunny Southern California. I'm 65 years old. My wife is 67 years old. We've both been retired approximately 15 years. The question is, should I transfer approximately $200,000 a year from our regular IRAs to our Roth IRAs? That would bring us up to the 24% tax bracket. Here's the breakdown of what we have. I have a Roth of $70,000. Wife has a Roth of $70,000. I have a stretch IRA of $190,000. I have a regular IRA of $192,000. Wife has a regular IRA of $240,000. I have a SEP IRA of $600,000, and our brokerage account has $6 million in it. My wife currently does take Social Security, which is about $900 a month, and I don't plan on taking Social Security until I'm 70 years old, which will be about $4,100 a month. Our taxable income is $175,000 this year. Here's the dilemma. Starting in 2031, we will have to start cashing in the I-bonds that we bought in 2001. In 2001, we put $60,000 into I-bonds, $30,000 each. So in 2031, they'll be worth $300,000. Which puts us at a $240,000 profit, obviously. Now, this is going to keep happening until 2035 because we bought them for 5 years in a row. $60,000 in 2002, 3, 4, and 5. Now, due to health concerns on myself, I will probably only make it to 75, maybe 77. Wife, I plan she's going to be till 95. Her mother's still alive. She's in very good health. Household, we have a 5-year-old Bernedoodle who still thinks she's a puppy. My day drink is a Coors Light. But if I'm on vacation, I'll have a vodka anything. Wife likes a red wine or a Stoli martini when she's on vacation. Thanks, and hopefully you can spitball this for me. Thanks again.
Vodka anything.
Vodka anything.
Vodka anything.
They drink Coors Light.
Oh, perfect.
That's a good.
You start the morning with a little Coors Light.
You know, I don't do that.
Vodka anything.
I don't do that, but I do. I have been known to have Coors Light on the golf course in the afternoon.
Yeah. So he's been retired for 15 years.
Yeah.
So at 50.
Right.
Yeah.
Congrats.
Cool.
That's a great story, and he's got a lot of money saved.
$175,000 of taxable income.
Yeah.
So just
without working.
Yeah, I'm just curious on what that breakdown is.
Yeah.
Is it interest and dividends from the $6 million brokerage account? Is there pensions in there?
I'm guessing, right? I mean, if you just go at 2% dividend rate, which, who
Sure.
knows? Because a lot of it's interest income, could be 4%, who knows? But if we just go with that, that's 120,000 just right there.
All right. So his question is should he do a conversion of $200,000 this year to get him to the top of the 24? So how much did you add up how much he has in retirement accounts?
Well, it's
$6
about
million, $8 million?
1.4 million.
1.4 million?
Some of that's Roth. Let's see. Roth is about 140. So let's just call it 1.2 million.
Okay.
Something like that. The fact that, well, first of all, he's going to have a lot of extra income starting in 2031. And that will be while he's taking his RMDs, which will add to the top of that, right? We know that at the end of 2025, the tax rates are scheduled to go up. They may be extended, they may not, right? So he's saying he could do a couple $100,000 and stay in the 24% bracket. Maybe that's not a bad idea. He's got the funds to pay the tax.
Let's say his IRA goes to $2 million by the time he has to take an RMD.
Right. It adds another
$80,000
of income on top of
80,000 on top of another. Then he's got Social Security at that point because he's not taking that. That's going to give another 50,000 of income.
Yeah,
on
and even without the I bonds, a couple 100,000, he'll be what is. I mean, the future tax bracket will be at least 25%, if not 28, if we revert to the old rates.
Right.
So converting at 24 seems like a good plan.
Probably. Yeah, I mean, I think with most people, if he didn't have the giant bag of cash of $6 million, we'd probably say no. Because
it's 80,000, which is a big number for RMD, but it's not like it's hundreds of thousands.
Right. But with his added income and then the RMD on top of the Social Security plus all the interest and dividends coming from the brokerage account.
Yeah.
Yeah, I think the 24% tax bracket is probably the right bracket to think about, paying tax at today.
Yeah. And so the IRAs, let's see.
And then if he's got short life expectancy as well, the RMDs for his wife is not going to change.
Right.
And so now she's going to be at a single tax bracket.
Right.
So then you still have a large RMD for her for the next 20 years after that, plus the interest and dividends on a single bracket. They're gonna pay a lot more taxes down the road, depending on really what they want to do with this money.
I think so too. And then I might even continue that in 2026 if the rates get extended. If not, I'm not sure I would.
Yeah. All right, David. Congratulations.
Vacation. Hey, I got a quick question.
You're retired. Aren't you on vacation all the time? You're kind of quasi-retired and you're on vacation all the time.
Well, if you go by me, the answer is yes. But yeah, he's got all these I bonds too, and that's the way I bonds work. With I bonds, you can actually elect to be taxed each year, or you can wait till the end, which is what most people do, and that's what he did. And it's great. You get that deferral for quite some time, 30 years, but then you got to pay the piper.
So is that the deal with the I bonds, that at 30 years you have to start selling them? Because he says he has to.
It's a 30-year term, so
got it. Okay,
happens whether you want to or not.
Yeah, it's a loan.
Yeah.
Basically, and the loan comes due and you get your money back.
Right. Plus interest.
All right. Yeah, it's a good problem to have. You put 60 grand in, you get a couple hundy.
I love it. I mean, a lot of us would love that problem.
Yeah, I know. All right. We got Kimberly from Iowa. She's got a question on a Roth conversion. She's 61 years old. Want to do Roth conversions over the next 3 years before the new tax rates go up in 2026. I was in the 24% tax bracket in 2023 and of 2024 in only doing part-time work, estimated $12,000 a year. Okay, so she's got about $400,000 in a taxable brokerage account, $450 in an IRA, $200 in her 401k, another $200,000 in a 457, and $200,000 in bank CDs. Her monthly living expenses is $600K.
Yeah,
wow.
I think that's a typo. I think she meant 6,000.
600,000, Kimberly, in
Iowa.
That
would be
600,000 a month.
That would be a record for our show.
That's Big Al's living expenses.
I can't even spend that.
That would be living large.
That'd be hard to do. Right?
It would be almost a.
Okay, so let's assume she meant 6,000 a month.
All right. So let's go here. All right. Question: should I max out the 24% tax bracket, or what would you recommend? So she's 61. All right. As single, or do conversions over several years until my Social Security age at 67. She's got no kids, planning to pay for the conversions with the bank account. Can I do all with the brokerage account instead? Also, possible plan to do QCDs at 70 and a half. But this would help lower my RMD in the future. My goal is to convert my 401k to traditional IRA this year and then convert IRA to Roth IRA. All right. So let's see. Again, she's single. We don't know what. So her taxable income is $12,000 a year.
Right. And she spends
$6,000 a month.
Yeah. 72 grand, call it.
So she needs a little bit of money to live off.
She needs about 60,000 to live off of. And the assets are about $1.5 million, which is right there. That's even without Social Security, right? So it seems like it's okay.
But converting to the top of the 24% tax bracket, given the amount of money that she has in retirement accounts, seems a little rich to me.
Yeah, I would say so too. I mean, if you look at the single brackets, I mean, the top of the 22% bracket's 100,000, of income. She only has 12. She could think about that one.
Yeah, I would convert over time. So,
You know, the other,
if she wants to do QCDs as well,
Yeah.
I mean, I would be really careful about doing giant conversions.
I would too. And in fact, based upon the fact that assuming she doesn't need all this money, I mean, usually when you do a QCD,
yeah,
qualified charitable distribution at 70.5 can count for your required minimum distribution at either 73 or 75, depending upon your age. That's a good way to go if you're charitably inclined and don't need the money because you don't have to pay tax on it. But if you need the money, you need the money.
right. So I think from a Roth conversion perspective, there's a few things people need to think about from a strategy perspective. Is that a lot of times when we recommend or talk about Roth conversions, it's to help people get more diversified from a tax perspective in their retirement years. Because most people have a bulk of their savings in this 401k, IRAs, 403b accounts, and all of those dollars are going to be taxed at ordinary income rates.
Right.
So then they have Social Security, they might have a small pension, they might have interest and dividends, and then all of a sudden these RMDs might kick them up into a lot higher tax bracket. Or if tax brackets go up, there could be an arbitrage here by taking advantage of lower tax rates today.
Right.
With her, it's unless she does spend $600,000 a year, which I don't think she does.
A month.
A month.
A month is all right. Well, you want to be strategic to say, all right, well, what is my RMD tax going to be if I don't necessarily need it? And she's already telling us, well, hey, I might just give it away to charity anyway.
Yeah.
So the tax on your RMD is going to be zero.
Right. If you do that. Yeah.
So you look at what tax bracket you're in today, what tax bracket you're going to be in the future. But she was in the 24% tax bracket while she was working, not necessarily while she was retired.
Right. Yeah. Good point. And we don't know what her Social Security is, but here's what I think I might do based upon the facts in front of us is the 12% bracket goes to 47,000. Plus you got the standard deduction of about 15,000. So let's call it 60 grand. 60 grand, she makes 12. So she could do conversion of 45,000, something like that. Stay in the 12% bracket, get a bunch converted in a lower bracket. That's probably, based upon what I know about her, that's probably what I might do.
She's got $800,000 in retirement accounts roughly.
Yeah.
So over the next 4 or 5 years, you get $50,000 out.
Right.
That's a few $100,000 out of the 8. You're going to probably get a third of it out.
And even if the rates change back to what they were, then the 12% bracket will
Goes
be
to 15.
It's not that bad. I would still keep doing it.
Yep. Yeah, I would be, some people get all rambunctious. Just this one guy, it's just like, well, Joe told me to rip the Band-Aid off. So I'm going to convert like $4 million. It's like,
wait a minute.
Calm
Hold
down.
on. Let's be sensible here.
Yeah, I love it.
Right.
Yeah. Anyway. But you want to be sensible. All right, Kimberly, congratulations on your success here.
Yeah, fantastic.
And I would slowly kind of bleed this thing out. So, all right, we got Blake writes in. Hello, found your videos on YouTube. Appreciate your philosophy and approach to retirement planning.
Well, thank you, Blake.
Yeah, we have a philosophy on retirement planning.
I think we
is it a philosophy?
It's very simple. Spend less, save more.
I don't know if it's a philosophy.
Convert to Roth.
Convert
it's
to Roth.
really good planning.
Invest globally diversified, low cost funds.
I'm 59 and a half, single, reside in Florida. My company's downsizing. I might be offered a little severance package.
Ooh.
If I'm willing to retire right away. All right, the severance is 2 weeks pay for every year on the job.
Okay.
I started in the company on February 1st, 1988.
Wow.
Jeez.
I happen to know that was 36 years ago because that's the year I got married.
Date of my birth.
And we celebrate our 36th anniversary in April.
It's close to the date of my birth.
Give or take a decade or two.
Yeah, give or take a couple of days.
Decade? That's a stretch.
Yeah. Had
a little more.
We know. Had not planned to retire.
I happen to know you just had a birthday.
Yes, I did.
I'm not going to divulge which one.
Had not planned to retire until 63 or beyond the years of age, but maybe this package should be considered.
Okay.
I'd like to know your thoughts. All right. So what's the number here? So he gets 2 weeks pay for every year on the job.
So that would be
working for 36 years.
Yeah. So that would be 72 weeks. So
his base salary is $150,000.
yeah, I'll call it 180, 190, something like that.
Okay. So he's making 150. Average bonus is 40. Rental property annual income is another 40. He gets interest income of another 30. So he spends 50,000 and he's making plenty of income.
Yeah. So
all right, retire. You're good. Take it.
We think, Blake, you already know the answer.
All right, Blake. Good.
Check.
Take that job. And
you are financially independent.
1988. You're like, hey, Blake, it's time to go, bro.
Yeah. Wow.
You've been here 36 years. He's got $2 million in a retirement account. He's got 650,000. Come on, Blake.
Yeah.
Killing the game.
Let's call it $2.5 million at Fidelity. Yeah. Got money at PNC, another 100,000+. He's got pensions and Social Security.
You got millions.
Which more than covers living expenses.
Do what you want to do, Blake.
Yeah. Have
You're
fun.
Good.
Take the severance if you get offered. That's a great deal. That's a year and a quarter-ish of pay.
And he wants to spend 50?
Yeah.
So that's like 3 years of, or what is that?
Yeah, call it 3, almost 4.
4 years of living expenses with the severance.
Right. Plus you don't need it. So yeah, go ahead. Have some fun. You've worked hard, 36 years. That's probably just about a record in today's.
Do you think Blake knows how to have fun? We got to get him out there.
Maybe he's been working so hard.
He's been grinding
since
1988. Like, when was the last time we got someone who's been at the same employer for almost 40 years?
Yeah, I don't recall.
It's been years since we've met, talked, or So congratulations for your longevity and loyalty to this firm.
That's a rarity to have someone basically company man the whole career.
Yeah, feels like I've been here for 36 years, but I'm going on almost. We're going on almost 20.
Yeah, we're getting up there, aren't we?
I know. So, all right, congrats, Blake. Yeah, take the severance.
We were both young men when we
very young.
This company started.
God, I was just right out of high school,
especially you.
If you decide to take a new gig after taking that severance, compensation options may be a lot different than they were when you started working 40 years ago. Understanding RSUs, NQSOs, and ESPPs can be like learning a whole new language. Register for our free Equity Compensation Basics webinar on Wednesday, July 24th at noon Pacific, 3 p.m. Eastern. Ian Barr, CFP MBA from Pure Financial Advisors, will define the options that may be offered in your new compensation package and explain how they work so you can negotiate the benefits that will help you maximize your earnings and meet your long-term financial goals. Get all your equity compensation questions answered live in this free webinar. Just click the link in the description of today's episode in your favorite podcast app to sign up to attend.
I'm 47 years old. My wife's 46, y'all. No pets. 17-year-old daughter. We both drive Tesla Model Ys. Drink of choice, me, stout. Wife, lemon drop.
Okay. Now that we got that cleared up, is there a question?
Yeah, I doubt it. I haven't read that far.
Okay.
Q.
Oh, there's the question. Q.
Oh, question.
Q.
Oh, thank you for that. Maybe you should. Oh, Q. Here's my question. In my brokerage,
my Q.
Yeah. While tax loss harvesting, improving my expense ratios, I sold a high expense ratio fund that I could harvest a loss and move into a lower expense ratio fund the last week of the month. A day or two later, the month's dividend was deposited into my account as a new purchase of the same fund I just sold. I immediately sold it. Is that a wash sale rule? And canceled my lost harvest? Thank you for the podcast. Vancouver, Washington is where Patrick's from.
Right. So that's so there's a rule, right? Which is if you have a security at a loss, whether it's an individual stock or mutual fund or index fund, if you sell it at a loss, which you can do, you can't buy that same stock or mutual fund within 30 days. Now, when you get a dividend, like most people with their mutual funds, index funds, they reinvest their dividends. And when you do that, that's counted as a purchase. And the answer, Patrick, is yes, it does affect the wash sale rules, but only to the extent of the dividend that you
purchased.
So let's just say you sold 100 shares and you got a dividend of 5 shares. Okay, so then 5% of your loss, roughly, if you use the average cost basis, is disallowed, right? Because you you violated the rule. But the other 95% would be okay.
Well, let's break this down a little bit more just for my layman purposes here. So tax loss harvesting is a strategy that if you have money in a brokerage account, if this doesn't work for retirement accounts.
Yeah, we have to be very clear about that because people want to do that in their IRA and it doesn't make any sense.
And then sometimes when people hear, well, why would I want to sell when it's down?
Yeah.
You know, I thought you're supposed to buy when the market's down and sell when the market's high.
Yeah.
And that is very, very true.
Yeah. In a perfect world, that's what you would do.
Yes. But there is a tax strategy that you might want to consider. It's called tax loss harvesting, where you can harvest losses within the overall brokerage account. So then any future gains would offset from the losses that you harvest. For instance, you have a mutual fund, XYZ mutual fund. It is down $10 a share. So you would sell that XYZ mutual fund, but you wouldn't go into cash, right? You're not selling out because the market's down. You would just buy something similar. It can't be identical. It has to qualify for a couple of different rules, but you get the gist. You're still in the market.
Yeah. So you sell one mutual fund or an index fund or stock and buy another one.
So what Patrick did, he's like, hey, I have this mutual fund that I've been trying to get rid of. It's a really expensive fund. Hey, it's down in value. I'm going to sell it and I'm going to replace it with another fund with a lower expense ratio.
Right.
So as long as there's some differences here that qualifies. So now he has a loss on his tax return, but he bought the same day into a different fund. So he's still in the overall market.
And that's okay.
So when the market now recovers, so let's say he sells another fund at a $10 gain. Well, he banked a $10 loss. So his gain in his loss would offset dollar for dollar, and he would pay no taxes on that overall exchange. So tax loss harvesting is a huge tax benefit for people that have monies in non-retirement accounts. And so he's doing some really savvy, I guess that's the word of the day, savvy.
Yeah.
Savvy tax planning here.
Right.
But the IRS says, hey, this is a pretty good deal for you. So you can't buy that same fund back. There's a 30-day wait period to buy the exact same investment back. But what happened with Patrick is like, oops, a dividend was distributed when he was right in the middle of this transaction.
Yeah.
And it bought back the same fund, but it was only a few shares of that fund is what we're saying.
Yeah, only a few shares. And so that was a purchase that does violate that wash sale rule because you bought within 30 days, but only, like I said, to the extent of the shares that you got in the dividend. So most of your tax loss harvest will be okay. It's just that whatever percentage, right? A number of shares that you got in a dividend versus the number of shares that you sold. So I guess another thought about this is, I mean, if you're really wanting to do this perfectly, before you did this transaction, selling at a loss, you would turn off the dividend reinvestment in your mutual fund or index fund and then sell it, and you wouldn't have this problem. But it is an issue. You know, another thing I think is interesting on tax loss harvesting is you can't buy a substantially identical fund or you can't buy the same stock. You can't sell Home Depot and buy Home Depot. You
buy
can sell
Home Depot and buy Lowe's.
If you sell a S&P 500 index fund, can you buy another S&P 500 index fund? Probably not, because they're substantially identical.
They're identical. You could probably buy a total U.S. stock market fund.
Right. You could probably do that. But what's interesting to me is the IRS has never really issued clear guidelines on what's substantially identical. So it's somewhat up to your opinion and thought. Just don't go crazy.
Yeah, because let's say if he had a fund, well, if it was let's say if it was an actively traded mutual fund, which it's probably because if he has a high expense ratio, that could have a broad array of strategy within the fund, and he bought maybe the S&P 500. I think that's all right. But like you said, I mean, we see people, all right, well, here, I'm going to sell this Vanguard S&P 500 fund, and I'm going to buy the Charles Schwab S&P 500 fund,
right.
SPY, or I'm going to sell the mutual fund and buy the ETF.
Yeah.
You got to be careful there.
Got to be careful. The other thing in this scenario, which is, it's just unfortunate, but usually when you violate the wash sale rule, then you just add to, you don't get your loss, but you get your higher tax basis in the security that you bought. But in this case, you already sold it, so you don't even own it. So I actually think you're out of luck on that small percentage of the loss that you didn't get.
All right, Patrick, hopefully that helps. We got Seattle, or John from Seattle. Hey, Joe, Al, Andy, love the show. In your passion for Roth.
There
I
you
have
go.
such deep passion.
Passion for Roth.
I have such deep passion.
You do
for
have
Roth.
passion for Roth.
I do. Just
Rip the Band-Aid.
I listen to your show every week on my commute.
Nice.
And I'm hoping you can help me with a question. I'm driving a boring SUV and my wife drives a Tesla, and neither of us drink. We are both 42 years old. I earn $18,000 every 2 weeks. Really? You want to give me your biweekly income? Oh my God. This
Well,
is a
let's see.
first.
That's
Oh, I gotta multiply that by
it's over 400K. I'll put it that way.
what? I make $18,000
Every 2 weeks.
every 2 weeks. I make $18,000
What do you make every 2
every
weeks?
hour. I have no idea.
Me neither.
Oh, okay. And she earns $4,500 twice a month. Oh God! Now we got biweekly and bi-monthly.
That I can do. 9,000 a month. Call it 120,000 a year.
John, he needs to have a drink.
Yep.
We spend $53,000 each quarter. I didn't bring my calculator. Do you got the math here, brother?
Remember?
Can you help me out? Here's the rules, folks.
I got you.
You got to give me annual numbers.
I got you. So he makes 450, she makes 110. So that's 560. And they spend, let's call it 220 grand.
All right.
How
Thank
about
you. Okay. Oh, and expect to reduce this by 80% each day for the. No, I'm kidding. So we spend $53,000 each quarter and expect to reduce this amount by $80,000 in retirement. I'm adding about $850 per paycheck to my 401k plan, weighted a little more towards the Roth than traditional.
Okay.
She doesn't have a Roth option and averages $20,000 per year in the 401k savings. We each do backdoor Roths to max out, and we do the same with our HSAs. Currently, we have saved around $870,000. 80% of that is pre-tax. Every 3 weeks, we make a contribution of $1,000 to our kids' college fund. We plan to retire at age 60 if possible. My question is, how important is it to have international stock in our portfolio rather than U.S.?
We could have got right to
Oh
that.
my God, Sean.
Everything else is not terribly relevant, except how much you have invested.
I'm just thinking about, oh my God, if a train is going
Did you ever get those questions right?
oh my God, at 200 miles an hour when it leaves Tulsa, and then every city, oh my.
Oh yeah, those are ridiculous questions.
Okay, yes, John, invest in international stock, please.
Yeah, and here's the reason. The reason is international stocks tend to go up and down at different times than the US market. So it just gives you a little bit more stability. And however, you look at the last decade or more, international stocks have not done that well. And people would say, well, why international? Well, 10 years before that, from 2000 to 2010, international did quite well. And the US market actually for a 10-year period went down. So you want to have some of both just to kind of even out your portfolio returns.
Yeah, I think a broad rule of thumb, which I don't think anyone really cares for, but 50-50 of your stock portfolio is probably the right starting point. But I think most people have a home bias.
Yeah, most people do, myself included.
Yeah. And so it's like, all right, well, maybe I want 60 or 70% of my stock allocation towards US stocks.
Right.
And 40 or 30%.
Yeah.
So, but yes, you want to make sure that you have a globally diversified portfolio. And then you want emerging market stocks. So like in the international sector, there's really good companies that are not in the US.
Yes.
And so when you look at that, you could buy value international stocks, you could buy growth international stocks, you could buy small company international stocks, you could buy large company internet. So you still want to be broadly diversified in your international stock selection.
Right.
And then you can go into emerging markets, you can have small, you can have value, you can have growth. So depending on how detailed that you want to get, but I think from a very high level, you could just say the total international stock market, I want 20% allocation to my stock portfolio allocation. And then from there, you can toggle it back and forth. But yes, I guess I answered this question. And then you want to add it biweekly. But and then
with
every
your-
other quarter,
with your paycheck.
then you do a
bi-weekly.
rebalance.
That's true. Check it 4 times a year. Make sure you're in balance. All
Right.
good.
Thanks, John. Good sport.
With the money you've got saved right now, will you be able to retire at age 60, 65, 70? Never? How would a market decline affect your plans? Doctors Joe and Big Al are in the house on Your Money, Your Wealth TV with your retirement rescue plan. Check it out in the podcast show notes, comment on YouTube, and make sure you download the free Companion Retirement Rescue Guide. This special offer is only available for a very limited time. You got to download it by this Friday. Revive your retirement and learn how to go from just barely surviving to thriving. Click the link in the description of today's episode in your favorite podcast app. Go to the show notes. You'll see the TV show, the guide, and other free financial resources like the Investing Basics Guide and 10 Steps to Improve Investing Success right there before the episode transcript.
All right, we got Brian from North Carolina. Hey, Joe, Big Al, writing from the great state of North Carolina. Tar Heels.
Yep.
Michael Jordan went there,
Yeah. That's actually one of the few states I haven't been to, but I want to.
Okay. That's on the list.
It's on the list.
Okay. My wife and I don't drink much alcohol, but love kombucha. I drive a Toyota Corolla.
Yeah.
I'd like to know your thoughts on what marginal rate to stop doing Roth 401k contributions. My wife is 30. I'm 30. Just got married in February. Congratulations. And found that we are fortunate enough to land in a combined state plus federal 28.5% tax bracket. After some recent promotions, I make about $140,000 a year working for the federal government. She makes $155,000 a year working for a tech company, plus she gets some RSUs. Do you think we should do all traditional 401k? And how would you approach this decision? I see folks online regularly recommend traditional 401k since people generally land in a lower tax bracket in retirement. For added context, he's going to have a pension. I knew this was coming.
Yeah.
I will have a first pension in retirement of about 40% of my salary, which will push up our taxable income. I've also been able to stock away a lot of Roth balances before reaching this bracket. Thanks for taking my question. All right, Brian.
Great question.
30 years old.
Yeah.
Just got married. So they make a really good income.
Yeah, call it 300,000.
28% tax bracket combined. So 300,000. So they're in the 24% tax bracket.
24% bracket, yep. So what do you think?
At 30 years old, at 24% tax bracket, I would go all Roth.
100% Roth. Yeah, and here's why. The 24% bracket actually goes to 383,000. We'll call it 380, right? And then you got a standard deduction of 29,000. We'll add those two together. So roughly $410,000 of income allows you to stay in the 24% bracket at age 30. When your income, and specifically your wife's income, will probably go up. If you're working for the government, maybe there's certain ceilings, but still your income joint will probably go up. Go ahead and do all Roth right now. Once you get to the point where you're broaching the 32% bracket, I might change.
Well, yeah, I think over the next couple of years, I would go 100% all Roth.
Yeah, agreed.
And then see what happens with tax brackets. And then also, you got to take a look at her RSUs. If she gets giant RSUs, 1 year, the tech company does really well,
right,
and then that pushes you up into a higher bracket than the 24, then you probably want to, switch that up and say, all right, well, here, we have to shelter some income.
Yeah. And yeah, so that's tricky though, because you're doing your contributions during the year and you may not know till later in the year. So it makes it a little tricky. So you do sort of have to forecast a little bit, but if you think you're going to go into the 32% bracket, I might take a little pause, but you're right, Joe. The rates may be totally different in 2026. They're scheduled to be different. So you're just going to have to watch that.
Yeah. All right. We got John from DC. Dear Al and Joe, 57. My wife's 59. We live in DC and drive a 2018 Toyota RAV4 and a 2019 Honda Accord. We are a beer and bourbon couple, but do enjoy a great bottle of bread, especially with steaks. All right, we have a combined income of $450,000 a year. My wife plans to retire at age 60, and I would like to join her in 2 to 3 years after. We have a net worth of $4.6 million today. Wow. Way to go, John.
Fantastic.
We have $500,000 in home equity, $3.3 million in taxable retirement accounts, and $700,000 in Roth accounts. We have $50,000 in our brokerage account. At retirement, my wife will receive a pension of $50,000 a year, and we both plan to take Social Security at 62, which will be $68,000 a year combined. Our retirement income goal is $180,000.
Okay.
All right.
We got about $4 million liquid.
Okay.
That's 60. Yeah.
All right. We're pretty close there, bud.
Yeah, I think that works.
We will likely have an opportunity to purchase a Delaware waterfront family property in the next 24 months for a total of $1.2 million for our new retirement home. Can you spitball what impact this purchase withdrawal might have on our retirement spending goal of $180,000 per year? Also, would you structure the withdrawal to minimize the tax liability? We are concerned about the sequence of withdrawals as well. Thanks for all you do. All right, John. Congrats. Little Delaware retirement family property. Is it? Are they going to live there full time, or is this going to be kind of like a summer gig, you think?
Yeah.
Well, it says their new retirement home.
Yep, it does say new retirement. So let's assume they're going to sell. So they're going to need $700,000 from the portfolio.
I would take a note.
Well, no, I take a note. I'm just saying they have $500,000 of home equity.
Sure.
Yeah. I mean, yeah, you're right. You could take a note, but I'm just going to go simple right now because they're probably going to buy new furniture and things like that. The 4 million could become 3 million after they're said and done, unless they take a bigger note, which maybe they should. But the trouble with that, Joe, right now is interest rates are so high on mortgages, so it's a little tricky. So you got your calculator out. So while you're doing that, I will continue to talk. So
all right, here's what I did: is that he's going to buy the $1.2 million retirement house.
Yep.
He's going to sell his DC home.
So $500,000.
$500,000. We're going to assume that there's no tax on that home, that they qualify for the 121 exclusion. So that $500,000 of home equity is going to come to him tax free.
Right.
Takes the $500,000, put it down. He's got a $700,000 note.
Right.
I ran this at 7%.
Okay.
It's going to add another $56,000 a year to his expenses.
Yeah. But you've got closing costs on both ends.
Let's not get all technical, Al. My God, this is called a spitball. It's not a retirement analysis.
They're going to buy new furniture. You can pretty much guarantee that.
Just because you refurnish every house that you purchase every 2 years.
Okay, let me be quiet. You continue.
Okay, so he's going to need like $240,000 a year. So $240,000 a year at 4% is going to be $5 million.
Yep.
Right.
And he's got 4.
He'll need 6.
Yeah.
He wants to retire when?
Age 60. So
no.
Wife plans to retire. So next year.
Okay, $240,000. What's his fixed income?
Well, you got to take away let's see, call it 50,000 pension. So take that away even before Social Security.
Okay, 50,000, 190, and then what's Social Security?
68 if they take it both at 62.
Okay, we're going to say 70,000 minus there, 120.04 divided by there. He needs $3 million liquid. You take 4% of $3 million is going to cover the 120, but you got closing costs, realtor fees, lawn maintenance.
No, I think it works.
Summer house, lawn furniture.
All right, mister. Let me
do swimsuits.
You do. It's going to be on the water. It's waterfront. You got to get a boat.
A boat. Oh my God, the boat insurance.
Yeah. So I agree with you. I think this works. Here's my comment though: is I'm not sure I would be taking all my Social Security at 62.
Yeah, me neither.
At least at a minimum, I would take the higher benefit and stretch it out, just because then that's more of a guaranteed retirement or guaranteed income for life for either one of you, whoever survives the other. That's probably what I would think about. But yeah, I think this does work.
I would take a note, and then you could always refinance down the road when hopefully interest rates go down. But I don't know, they could always go up too.
Yeah.
Or if they're like, you know what, I don't want to do this. You take that $4.6 million in retirement accounts, or no, I'm sorry, $3.3 million.
Yep.
You take 700,000 of that. That's $1 million.
Yeah.
Just because of the tax that you're taking from there.
That's true.
So then you think about, all right, does it make sense for me to pay interest, or does it make sense for me to pay the IRS by taking a huge lump sum out to be debt free?
Yeah, when you think of it that way, 100% agree, because I wasn't even thinking the money's in the retirement account.
Yeah,
But
most of it's all there.
Yeah, it's all there, and you don't want to touch your Roth accounts. You worked very hard to get it in the Roth. You want that for your retirement. So yeah, you would need to finance, and that does make sense. Yeah, I agree with you. You just watch the rates. As soon as you can refinance to a lower rate, hopefully at some point, then you do that.
Yeah, and I don't know, $180,000 of living. You probably do that for. I mean, that's a pretty good lifestyle.
It is. Yep.
Probably do that for 10, 15 years. Your lifestyle is going to change things. I don't know.
Yeah.
It's close. It's tight, but of course, worry about those ancillary fees.
That lawn
That will blow you up. It's going to totally blow you up.
Oh, you want to do pavers. Oh, you want to do patio. You need stuff.
Al, I totally agree. I'm sitting in that same boat.
I thought if anyone could relate to
I
it, that's
relate to it 1,000%. It just makes me upset, so that's why I don't want to think about it.
Got it.
All right, that's it for us. I appreciate everyone hanging out. Al, it's good to be back.
Yep.
Been on a little hiatus for a couple of weeks.
Yeah, good to be back, and good that you're back. Welcome back. And
Andy, thanks for holding down the fort.
Yep.
Hey, thank you. It was fun. Had a good time with it.
All right. Okay. Well, man, I'm sweating.
We're back in the saddle.
It's time to go.
Yeah.
All right, we'll see you guys next week. Show's called Your Money Well.
Joe and Big Al are back, and so are the Derails. We're talking about the fellows' vacations, Brewster's millions, and of course, we're drinking in the Derails at the end of the episode, so stick around. This is Your Money, Your Wealth, Your Podcast. If you enjoy YMYW, tell your friends and help us reach more listeners like you. Don't forget to leave your honest reviews and ratings for Your Money, Your Wealth in Apple Podcasts, YouTube, and all the other apps that let you do that, like Amazon, Audible, CastBox, Good Pods, Pandora, Player FM, Podcast Addict, Podchaser, Podknife, and Spotify. We're on all of them. Your Money, Your Wealth is presented by Pure Financial Advisors. To really learn how to make the most of your money and your wealth in retirement, you need more than a spitball. Schedule a no-cost, no-obligation, comprehensive financial assessment with the experienced professionals on Joe and Big Al's team at Pure. Click the free financial assessment banner in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 to book yours. Meet in person at any of our locations around the country or online right from your couch. No matter where you are, the Pure team will work with you to create a detailed plan tailored to meet your needs and goals in retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.
Just an Iowa, Al.
You were. That's right. How was it? I don't think I've talked to you about that trip.
It was wonderful.
I went on a long trip, and you went on 2 separate ones.
Yeah, I was in Arkansas.
Yeah.
And I went to Iowa.
Yep.
Where were you? Portugal?
Portugal, Spain.
Yeah, almost
Germany,
the same.
Austria.
Yep. Almost identical trips.
Well, you went to Idaho too.
I did go to Idaho.
Yeah.
Coeur d'Alene, very beautiful place.
Was that your favorite?
Yeah.
Of your trips, because that was your golf trip?
Yeah.
Got it.
I don't know, Coeur d'Alene, Idaho, or
yeah. I've been there a couple times. Beautiful.
Have you ever seen the movie Brewster's Billions? Remember with Richard Pryor?
I think it was Brewster's Millions.
Yeah.
Or maybe it was
back in the day.
Yeah, I know.
So he inherited all this money. So he had 2 inheritances.
Okay.
So one, he had to spend all of this money,
Right.
spend it all the way down to get the bigger inheritance.
Got it.
And so he's buying baseball teams. He's doing all, and everyone is like, "What the hell are you doing?"
Right.
You know, he's buying icebergs.
Right.
Yeah, it was almost painful to watch.
Yeah.
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 It just damages people's lives.
Yeah. It can.
Lemon drop. Isn't that
Yeah.
a shot?
Lemon drop?
Yeah.
I think that's in that vodka and lemon.
I don't know, with some like sugar on top.
I think so.
The last lemon drop, it was in a shot. I don't know if I've ever had a lemon drop drink, and I think I was in college when I did this.
Vodka-based cocktail that has lemony sweet and sour flavor, prepared using vodka, triple sec, and fresh lemon juice.
There
It has
you
been
go.
described
You're-
as a variant or take on the vodka martini, but it's in back closer to a white lady variant.
Oh, I suppose if you put it in like a martini glass and then
Yep.
you put a little sugar on the rim or something.
That's how I've seen it.
Oh, that's fancy. Love kombucha. Kombucha. I've had that once. It tasted like almost.
It tastes like motor oil or something, doesn't it?
It burns.
It's not
burns your mouth.
Not very good. I don't like it either.
I thought I'd like try to be super healthy. Start drinking that. So
You got to learn how to pronounce it first.
kombucha. Okay.
I think it's kombucha.
Kombucha.
Kombucha is what most people say.
Yeah, I said kombucha.
Yeah.
Or conchamba.
Tomato, tomato. Who cares?
Yeah. Just, that stuff that comes in a glass bottle that burns the hell out of your mouth.
And that killed your desire to be healthy?
It was.
That you don't like.
So, no, I thought it was hip.
Right. Yeah, it is hip.
I had, I was in Coeur d'Alene, Idaho.
Yep.
Went to this little restaurant called the Beverly's.
And let me guess, it's a steakhouse.
Yeah, I didn't have a steak. I did have 2 old fashions, so it was pretty good.
You did. Okay.
Yeah.
Got it.
I had chicken.
Chicken. Okay.
Yeah.
Does it go with chicken?
I don't know. I was hungry. Yeah, I think.
Yeah. Remember I told you I got some German beer?
Yeah.
On the can it says, where
Pair
it
it with something.
says pears, and then it goes with everything, which is true.